More of us are paying our credit card bills on time. The credit reporting agency TransUnion says the rate of credit card payments at least 90 days overdue fell 19% from the same time last year. The average credit card debt also fell slightly to $4,800. The markets have been on a tear, and do we have more to run? Jonathan Satovsky from Satovsky Asset Management is back on the program to talk about that a little bit and to talk about Apple. I want to start with Apple because that's really in the news, but this is hardly the only company that is doing this with its cash. So what's the risk here of making them pay some more taxes?
Well, there's been a trend that's been going on for over a decade now. The number of actually publicly traded U.S. companies have been shrinking by about 43% in the last decade. So as a byproduct of tax policy or people, this risk that's going on with Apple is more and more of the IPOs that have happened over the last decade have happened globally. There's about an 11-to-1 ratio of new issued publicly listed companies.
And to walk us through that, that's because the companies have more favored tax structure elsewhere outside of the United States.
I think that the regulatory structure has gotten tighter and tighter, so there's been a reduction of opportunity sets for tax policy and just trying to put companies in a situation where that they can succeed.
So when John McCain says, well, they do all their research and development here, this is where their sales force is, they should be paying taxes here, are you saying that the risk is, well, they're going to have to pay taxes here, they're just going to move all of that elsewhere?
Well, listen, we want to have jobs here in the United States. We want to have a vibrant economy. But by the same token, a company wants to do business, and if the opportunity to be able to sell their products isn't just here in the United States, if the opportunity for Apple to sell products is in South Africa or in Asia, they're going to try to set up operations in those locations so that they can get the best bang for the buck.
Okay, let's talk a little bit about the markets because we have been on this run. You manage people's money. Over the past years, a lot of people have just sat on their cash. Are you starting to get phone calls from people saying, what's going on here? I need to get in, take some of this cash and put it to work?
Well, I think we have sort of a bipolar population. You know, as the population ages, there's more and more people who have been severely scarred by the last several crises over the past decade or so. So naturally, as people age, you're supposed to get more conservative. People have been retrenching their risk. And it's actually quite a difficult conundrum with financial repression because if someone rebalances and takes off equity exposure and buys fixed income or buys bonds, they're not really going to get much of a return.
So are you seeing people increase their risk tolerance, and does that concern you at all?
Well, there's been an increase in risk tolerance as a byproduct of not rebalancing quite as frequently, letting things run up a little bit higher. And when new money comes in, people are flush with cash. Once they have enough cash to meet their obligations and or they deleverage their own balance sheet, they have to decide, where do I put that future cash to work looking forward? And many of the opportunities on a bottom-up basis are more in the 30,000 companies around the globe than they are on the debt side of things.
So where do you see the opportunities right now for people to still get it?
Well, again, it depends on time frame. Without question, there's always a risk of a 20-30% correction in the markets. And I think that fear factor has caused people to be somewhat paralyzed and preventing them from getting fully invested. So it's likely that it's a very similar occurrence, what I see, of what happened in the 90s, when you had this anxiety level where people were apprehensive to invest, and you had what's called the pain trade. What outcome would cause the most amount of people discomfort with their current positioning possible? So what happens is the markets melt up, and all of a sudden people say, what am I diversifying for? I might as well be 100% invested in equity. So the risk is that we have this parabolic movement and people give up on everything else and get back to the 100% allocation just in time for the market to drop again, which is unfortunate because it's all time frame related. If we weren't thinking about things over 18 months or 6 months and you realize that you're investing for 7 to 10 years, you would take a much different stance in your policy.
Okay, Jonathan, thank you so much for coming on.
Thank you for having me.
We'll see you again soon.